Buying a business can be one of the smartest financial moves you make, but only if you approach it with a clear financial strategy. Too many aspiring entrepreneurs rush into business ownership without truly understanding the financial landscape they're about to enter. Whether you're purchasing a franchise, an existing small business, or a rapidly growing startup, doing your financial homework is essential. You need more than a dream and a loan. You need a precise understanding of cash flow, hidden liabilities, market position, and your own readiness to manage it all. Before you sign the dotted line, there are key money moves that can protect your investment, maximize your chances of success, and keep you from inheriting a financial mess. In this video, we'll break down the top 10 money moves you should make before buying a business. Moves that could save you from regret and set you up for long-term financial growth. 1. Build a personal financial safety net. Before you even begin reviewing businesses for sale, you need to build a strong personal financial foundation. Buying a business comes with inherent risk, and it can take months or even years before you see consistent profits. Having at least 6 months' worth of living expenses in an emergency fund will reduce your financial stress if the business takes longer to generate income than expected. Additionally, this safety net ensures you won't need to dip into business funds for personal needs, which is a common mistake new owners make. Your business needs its own capital, and you need yours. 2. Get pre-qualified for financing or secure your capital. Business purchases usually require capital, either from your own savings or from a lender. Before you start negotiations, speak to banks or lenders to understand what you can qualify for, how much interest you'll pay, and what your repayment terms might look like. Alternatively, explore other financing methods like SBA loans, angel investors, seller financing, or even leveraging a self-directed retirement account, if you understand the risks. Knowing your buying power gives you leverage when negotiating the price and also narrows your search to businesses within your financial range. 3. Understand the true cost of ownership. Buying a business isn't just about the sale price. It's about understanding the full cost of ownership. Beyond the initial purchase, you'll have to budget for ongoing expenses like payroll, inventory, equipment maintenance, rent, insurance, taxes, licenses, marketing, legal fees, and software subscriptions. You may also need to invest in improvements or rebranding. Before closing any deal, map out the total monthly and yearly operating costs so you're not blindsided later. A good rule of thumb: if you can't afford to keep the business running for at least a year post-purchase, you're not financially ready yet. 4. Conduct a full financial audit of the business. Before buying, demand complete access to the business's financial records. This includes profit and loss statements, tax returns, at least 3 years, balance sheets, accounts receivable, payable, inventory valuation, payroll records, and cash flow reports. If the seller is unwilling to share this data, that's a major red flag. Hire a financial professional or business accountant to perform a due diligence audit. This audit should verify whether the numbers are accurate, identify any hidden debts, highlight unsustainable trends, and ensure the business is not overvalued. This step is non-negotiable. It protects you from overpaying or buying a business on the brink of collapse. 5. Evaluate the business's cash flow health. Cash flow is the heartbeat of any business. Even a profitable company on paper can struggle if cash flow is inconsistent or mismanaged. Examine monthly cash inflows and outflows to determine how well the business manages its day-to-day expenses. Are there seasonal dips? Do they rely on credit to stay afloat? Are clients paying late? You should also calculate the cash flow coverage ratio to assess how easily the business can meet its financial obligations. Ideally, you want a business with consistent, positive cash flow, as this is what will pay your bills, repay loans, and grow the business. 6. Research industry-specific financial trends. Every industry has its own financial benchmarks, risks, and revenue models. Before buying a business, educate yourself on industry-specific financial indicators. For example, restaurants may have slim profit margins but high turnover, while software companies may have high upfront costs but excellent recurring revenue. Look into industry averages for profit margins, overhead, employee costs, and growth projections. Compare these to the business you're considering. If it's underperforming without a clear explanation, you may want to reconsider or renegotiate. Understanding the financial norms of the industry also gives you confidence when discussing numbers with the seller or negotiating with lenders. 7. Separate your personal and business finances. Before the sale is finalized, set up a legal business structure, such as an LLC or S Corp, and open separate business banking accounts. This will help you track expenses properly, make tax time easier, and protect your personal assets from business liabilities. It's also critical for establishing business credit and maintaining a professional image. Many first-time business owners make the mistake of running everything through a personal account, which quickly creates confusion and legal risk. Separating finances from day one sets a strong precedent for disciplined, professional financial management. 8. Budget for transition and learning curve costs. No matter how experienced you are, there will be a learning curve when you take over a business. This might involve hiring consultants, training staff, learning systems, updating technology, or fixing neglected areas of the business. In many cases, the seller steps away quickly, leaving you to deal with gaps in leadership or knowledge. Be prepared for a period of lower efficiency and potentially higher costs during the transition. Build this into your financial plan and expect that the first 6 to 12 months might not reflect the prior owner's performance. A buffer here can prevent early burnout or missteps. 9. Plan for tax implications of the purchase. Business purchases come with a variety of tax consequences, depending on how the sale is structured. Will it be an asset sale or stock sale? Are you inheriting any tax liabilities? What depreciation rules apply to equipment or property? Will you qualify for any deductions or credits as a new business owner? Consulting a tax advisor before you buy is crucial. They can help you structure the purchase in a tax-efficient way and ensure you don't unknowingly take on financial burdens. This planning can significantly impact your net income and future tax strategy. 10. Create a 12-month financial forecast. Before you buy, map out a 12-month financial forecast that includes your projected revenue, expenses, profit margins, and cash flow. Base your projections on realistic assumptions informed by historical performance and current market conditions. Build in best case, worst case, and break-even scenarios so you understand what success and failure might look like. A financial forecast helps you create goals, measure performance, and stay accountable. It also gives you confidence in knowing whether the business is truly worth buying or if you're walking into more risk than reward. Buying a business can be one of the most rewarding decisions of your financial life, but only if you approach it with intention, discipline, and the right money moves. Too many aspiring entrepreneurs fall in love with the idea of ownership without preparing for the financial reality it brings. By building your own financial foundation, auditing the business thoroughly, separating finances, and forecasting the road ahead, you put yourself in a strong position to succeed. These 10 steps aren't just about reducing risk. They're about maximizing clarity and confidence. Whether you're investing in your first small business or adding another to your portfolio, never skip the groundwork. Smart planning before the purchase can mean the difference between owning a thriving enterprise or inheriting a costly mistake. Let your financial preparation be your greatest asset as you step into the role of business owner.